Howdy, everybody. Welcome to Liberty Call. Today is Monday, January 23rd, 2023, and it's the weekly economic update going into this week. Hope everybody had a fantastical weekend out there. Lots of green on my screen here, so that probably makes some folks really, really happy. Looks like most of the world had a pretty positive day in their markets. So, again, some good news. Again, don't get too excited because it certainly could all fall apart sooner than later. And, based upon the long-term trend, that's, kind of what I'm seeing headed into, this, at least the first half of the year. Second half of the year, I'm not quite so sure. You could read a lot of different people's estimates on things, but I think things got to get a little worse before they're going to get any better, unfortunately. So, all right. Well, if it's your first time watching, give me some thumbs up, likes, shares, subscribes, follows, all that good stuff, depending upon where you're watching this. I would appreciate it. And let's go ahead and jump into the markets and see how they did today. Dow Jones was up 0.76%, closed at 33,629. S&P 500 up 1.2%. Closed at 4020. NASDAQ up 2.01%, closed at 11,364. Small caps are up 1 1/3. VIX was down 0.2 today. You think it'd be down a little bit more than that with the SP up quite a bit today. The VIX is currently holding at 1981. Canada was up 0.63. Brazil down 0.15. Mexico up 0.82. Jumping across the Atlantic, Germany was up 0.46. UK up 0.18, France up 0.52, Euro stocks up 0.75, Netherlands up 1 1/4, Spain up 0.29, Italy up 0.18, Switzerland up 0.98, and Portugal up 0.99. Both Russian exchanges were in the green today. The MOEX up 0.86, RTSI up 0.69. And the overnights in Asia, Japan was up 1.33, Australia up 0.07, New Zealand down 0.04. Chinese markets were all in the green. Shanghai was up 0.76. SESE component up 0.56. China A50 up 0.37. The Shanghai was flat at 0. Hang Seng up 1.82. And the Taiwan weighted pretty much flat at up 0.04. All right. So like I said, a pretty decent day for January 23rd across the globe, but again, things can change quick, so just be prepared. All right, well, let's go ahead and peruse through this week's weekly economic update. Week on Wall Street, stocks showed mixed results last week as recession fears resurfaced in response to weak economic data and a tepid start to a new corporate earnings season. The Dow Jones Industrial Average skidded or fell 2.7%. The S&P 500 declined 0.66, NASDAQ was down 0.55, and internationals lost 0.5%. Mixed economic data. Stocks weakened to start the week amid discouraging corporate earnings and troubling economic data. Disappointing retail sales and manufacturing reports sparked concerns that the Fed may have gone too far in hiking rates. I don't think so. If they'd gone up to like 10%, right, as of right now, you could make an argument that they had gone too far, but they've just been nibbling, like rats eating cheese, and haven't really been making much of a dent in it. Inflation has slowed down, but I think they could have gone a lot faster in my own view. While a drop in initial jobless claims diminished chances of a near-term pause in rate hikes, welcome news from two big technology names on Friday powered a strong rally that mixed significant indices. The start of the earnings season was a drag on investor sentiment, while 69% of the S&P 500 constituent companies that reported earnings by Thursday, 48 companies, exceeded expectations. The percentage of beats is below the 3-year average. More concerning, however, was that average earnings declined more than 2%. Consumers retrench. Retail sales fell 1.1% in December, capping off an overall weak holiday shopping season. November retail sales were revised downward to 1% from an earlier estimate of negative 0.6%. Compared to November through December of 2021, sales increased by 5.3%, below the 6 to 8% increase expected by the National Retail Federation. Many economists viewed the lackluster numbers as evidence of a weakening consumer. A more cautious consumer a more cautious consumer raises more concerns about recession at some point this year, since the primary driver of U.S. economic growth is consumer spending. All right, economic data coming out this week. Tuesday, we have the Purchasing Managers Index Composite. Thursday, we have GDP, durable goods orders, new home sales, and jobless claims. And Friday is consumer sentiment. Got a bunch of companies reporting earnings this week. On Tuesday, we have Microsoft, GE, Verizon, Johnson & Johnson's, Lockheed, Texas Instruments, Union Pacific, D.R. Horton, and Raytheon. Wednesday is AT&T, the Boeing Company, IBM, Lam Research Corporation, Abbott Labs, CSX Corporation, Next Era Energy, Kimberly-Clark, Norfolk Southern, and General Dynamics. Thursday, we have Intel, Visa, MasterCard, Blackstone, Northrop Grumman, Southwest Airlines, Rockwell Automation. And on Friday, we have Chevron, HCA Healthcare, American Express, and Colgate-Palmolive. So big week for earnings. I think this potentially could, kind of shift things as far as if we have a really good earnings week, we might have some more sideways markets or even a little bit of an uptrend. If it goes poorly, again, might resume the negative downtrend we've been in for 13 months now. So, all right. Let's go ahead and read through today's market recap, see what they had to say. SP 500 rallies as tech shines ahead of busy earnings week. The SP 500 jumped Monday as investors continue to pile into tech stocks ahead of a busy week of earnings. Apple led the run-up in big tech, rising more than 3%, followed by Meta Platforms, Alphabet, and Microsoft, with them set to kick off earnings for tech on Tuesday. Quarterly results for Microsoft, which announced a further investment into OpenAI on Monday, are expected to reflect on the impact of slowing demand, though recent cost-cutting measures, including layoffs, are expected to help. Quote, at this point, we see risk to prior fiscal year 23 guidance for commercial revenue to expand at about 20% year over year at constant currency, and total revenue growth grow double digits year over year at constant, given a more cautious outlook, end quote, Deutsche Bank said in a note. Salesforce, meanwhile, rallied 6% on news that investor Elliott Management has taken a stake in the business software firm. Chip stocks also played a heavy role in the rally after Barclays delivered bullish remarks on the industry as demand from AI applications such as ChatGPT and the China reopening is expected to stoke demand. AMD was upgraded by Barclays to overweight from equal weight, with the price target of $85 up from $70, sending the chipmaker's share price up 7%. Barclays also upgraded Qualcomm and NVIDIA, pushing both shares more than 7% and 6% higher, respectively. Western Digital, meanwhile, was also a major mover on reports. The company is set to consolidate operations, spinning off its flash business and merging it with Kioxia in a separate public company. Energy stocks lagged the broader market move higher, weighed down by a 1% fall in Baker Hughes after the oil field services reported quarterly results that fell short of estimates on both the top and bottom lines. In other news, Spotify Technology rose more than 2% after the music streaming giant announced plans to cut 6% of its global workforce. Chief Executive Daniel Ek issued a mea culpa, admitting the firm had investments that were too ambitious compared with revenue growth. All right. So like I said, looks like this week's earnings season could be, kind of a harbinger of how the quarter will go, but we shall see. One day or week does not make the quarter. All right. Up next, tax brackets for this year. Here are the federal tax brackets for 2023 versus 2022. The income thresholds for 7 federal tax brackets increased by a bigger than normal amount for 2023 tax year to reflect runaway inflation seen last year. Quote, there are just the usual changes due to inflation, end quote, John Witten from the Institute of Taxation and Economic Policy told Yahoo Finance. Quote, more dramatic this year since inflation was also dramatic, end quote. Hang on one second. Let me... All right, I'm back. Had to blow my nose. Didn't want y'all to see that. The inflation-adjusted amounts jumped by more than 7% from 2022, according to the Tax Policy Center, compared with last year's 3% uptick. The changes themselves are not a new development. The IRS adjusts its tax brackets annually for inflation. One positive outcome, taxpayers whose income didn't rise on par with inflation last year will likely avoid a tax bracket creep in 2023 and ultimately pay lower taxes. Yeah, it doesn't feel like that. For 2023 tax year, there are 7 federal tax brackets: 10, 12, 22, 24, 32, 35, and 37%. Your tax bracket is determined by your taxable income and filing status and shows what you'll pay on each portion of your income. So we can see here, most people fall into the married filing jointly. So everything under 22,000, you pay 10% on. From 22 to just under 90,000, you pay 12%. From around 90 to 190, you pay 22%. 190 to 365, you pay 24. And above that, it's 32, 35, and 37. Most people don't fall into these super high numbers, but anyways, remember, these are progressive marginal rates. It doesn't mean that if you have $100,000 in taxable income as a single taxpayer, you're taxed at 24% on the entire amount. Instead, the first $11,000 is taxed at 10. The next dollars up to $44,725 are taxed at 12. The next dollars up to $95,375 are taxed at 22, and the last dollars over $95,375 are taxed at 24. So yeah, whatever your effective tax rate is after all those brackets, you take how much you paid in tax, divide it by how much you had in gross income, and that gives you an effective tax rate as opposed to the marginal rates. According to the latest Bureau of Labor Statistics data, wages only increased 4.4% for the 12-month run ending September 22nd, up just 2.4% from a year earlier. Though some folks saw a jump in their salaries last year, most of those gains still fell behind rising inflation levels. Quote, the whole point of adjusting tax brackets for inflation is to reduce the impact or mitigate the impact of inflation, end quote. Eric Bronnenkant, head of tax at Betterment, told Yahoo Finance. Quote, let's say some people got a 10% raise in wages last year, while others may not have gotten any raise at all. Arguably, people whose income outpaced the estimate inflation hike of 7% may now be paying more taxes because their tax bracket is higher, while those with wages with little growth may be paying less, end quote. What this means is that taxpayers whose salaries didn't keep up with inflation are able to bypass bracket creep. According to the Tax Foundation, this occurs when inflation pushes you into a higher income tax bracket, which will reduce the value of credits, deductions, and exemptions. Quote, you still have to remember that a 7% tax bracket increase is still a rough estimate of inflation, and it's never about any one person's individual situation, end quote. Bronnenkant said, quote, it's possible that inflation was low, but you lived somewhere where your landlord increased your rent by 10% and your personal costs may have increased a lot. It's not perfect for everybody, but it's the best the IRS can do to average inflation for a large amount of people, end quote. Well, they could just get rid of income tax. It'd be a lot better. So, but if anyone needs any tax brackets or anything like that, just shoot me an email. I'd be happy to shoot you the literature I use when going through that stuff. So, all right. Last up, we have the Monday Morning Outlook from Brian Westbury. It's titled Rearview Mirror OK, Collision Ahead. All right. First, the good news. We estimate that real GDP grew at a solid 2.8% annual rate in the fourth quarter, but you shouldn't dwell on the solid GDP report that came out Thursday. Why? Because the report shows what's going on in the rearview mirror. Meanwhile, there's an economic collision ahead. Just think about the news so far for December. The ISM Manufacturing and ISM Services Index are both below 50. Excluding the early days of COVID, both indexes haven't been below 50, signaling at least contraction in sentiment since the aftermath of the 2008-2009 financial panic. Retail sales fell 1.1% in December after a 1% decline in November. Industrial production fell 0.7% in December after a 0.6% decline in November. Medium and heavy truck sales are still at a respectable level, but dropped sharply in December, down 13.5%, the second fastest drop for any month in the past 20 years. Housing starts declined as well. The good news is that the labor market still seems strong. Initial claims for unemployment insurance claims are still very low, but the job market is often a lagging indicator of economic health, and jobless claims should be expected to be at or near the bottom, very close to a peak in the business cycle. A recession will arrive sometime in 23. Given recent data, it would come as no surprise if we're already in a recession and the economy shrinks in the first quarter and beyond. A surge in M2 measure of the money supply led a rebound in economic growth from the COVID lockdown, and then a surge in inflation in 2021 and 22. But growth in M2 came to a halt in early 22. Now with the time lag, the economy is getting weaker and the inflation is coming down. Buckle up. It's going to be a rough ride. In the meantime, our calculations show economic growth at 2.8% annual rate for the fourth quarter. Consumption, real inflation-adjusted retail sales outside of the auto sector declined at a 2.4% annual rate in Q4. However, sales of autos and light trucks grew at 28% rate, and it looks like real services, which make up most of the consumer spending, should be up at a solid pace. Putting it all together, we estimate real consumer spending on goods and services combined increased at a moderate 2.3% rate, adding 1.6 points to the real GDP rate. Business investment, we estimate 4.1% growth for business investment, with gains in equipment and intellectual property more than offsetting a decline in commercial construction. A 4.1% growth rate would add 0.5 points to real GDP growth. Home building, residential construction is still absorbing the pain of much higher mortgage rates and looks like it fell at a 24% rate, which would subtract 1 point from real GDP growth. Government, only direct government purchases of goods and services, not transfer payments, count when calculating GDP. We estimate these purchases, which represent a 17% share of GDP, were unchanged in Q4, meaning zero net impact on GDP. Trade looks like trade deficit shrank a little in Q4 as exports declined at a slower pace than imports. We're projecting net exports will add 0.3 points to the real GDP number. Inventories look like they grew faster in Q4 than Q3, suggesting an add of about 1.4 points to the growth rate of real GDP. Look for slower inventories in 23, which should be a significant drag on economic growth this year. Add it all up and we get a 2.8% annual real GDP growth rate in the fourth quarter. That headline sounds good, but when much of the growth is from inventories and the economy is about to get hit from slower M2, investors need to focus on the collision ahead, not the pretty scenery in the rearview mirror. All right. So again, things looks like they kind of shaped up pretty good at the end of the year after a rough start to the first two quarters of 22. But according to Mr. Westbury, and I do agree with him, we're probably headed for more carnage this year, and we could already be in the middle of it at this point. So, you only know when you look back and say, oh yeah, Q1 of 23 was, in the red, and, hey, we're already back in recession again. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a fantastical evening, and I will talk to you guys next time. Adios.